Guys, we're looking at 3 stocks today. They're selling for under $50 per share to analyze them and see if they are stocks to buy right now. Stock number 1, Sofi. Guys, this is an emerging giant in the fintech world that's turning heads and rewriting the playbook for digital financial services. Sofi's member base has exploded past 10 million accounts as of December 2024, a gain of 2.5 million members this year alone, which is 33%. Guys, I count myself as one of those people. Why is this? Because Sofi is making financial services seamless, digital, and frankly, irresistible. From banking to investing, they're becoming a one-stop shop for millions seeking convenience and innovation. Now, as you can tell, this stock has had a big roller coaster ride, all-time high of $28 a share back in February of 2021. Now, here's the kicker. Nearly half of Sofi's revenue now comes from its financial services and technology platform, up from 39% a year ago. So what does that mean? They're no longer just a lending company. This diversification provides stability and reduces the risks tied to market-sensitive lending. In October, Sofi partnered with Fortress Investment Group for a $2 billion funding boost. This move supercharges their personal loans business while keeping it capital light, which is a fancy way of saying they're scaling without taking on a mountain of risk. Their revamped robo-advisor now includes alternative investments like real estate and multi-strategy funds, all for a modest 0.25% fee. And you guys know how much we hate fees when it comes to these strategies and these investment funds that people look at. This is a no-brainer for investors looking to diversify without breaking the bank. Now, by broadening their offerings, Sofi's drawing in a wider range of customers and increasing their assets under management. And here's the clincher. Sofi just posted its 4th consecutive profitable quarter with 5 cents per share in earnings. You guys, profitable fintechs are a rare breed, and Sofi is showing Wall Street that it has the staying power that everybody wants. So what's the bottom line? Sofi isn't just growing. It's evolving into a diversified, profitable powerhouse. For investors, this is one to closely watch. But remember, guys, just because the story sounds great doesn't mean it's a great buy. This is where we break down. This is where our principle-driven investing ideas come into play. Our job is to listen to the company, find out what the company is doing, but decide, is the price too high? And of course, everyone will say, oh, this price is fine, but the next price is too high. But when you're paying absurd amounts of money, when you're not looking at every investment as the present value of all future cash flows, you might get yourself in trouble. So, like I said, Sofi hit a high of $28, and just this year it had a low of $6 per share. And now it's at $14.68. Negative free cash flow, but they just reported net income in the last 12 months of $214 million. So, this is a big negative cash flow number relative to this net income. You know how I feel about that. Now, doesn't mean that you shouldn't invest in Sofi just because of this. But when a company is losing free cash flow, there's only 2 ways in which they can cover those losses. Taking on debt or taking on equity, which means increasing their shares outstanding. Let's see how they've done on that so far. We're going to go to the 8 pillars. And guys, look at this. Shares outstanding up 850%. That's absurd. So guys, this is dilution city. This is one of the worst we've ever seen. 850% increase in the number of shares outstanding. This is dilution to the max. Just to show you, let's look at their revenue in that time period. Their revenue is up, let's see, 6x in that time period, yet their shares outstanding are up 9.5 times. That means you've seen 0 growth if you look at revenue, if you invested back here, because the number of shares outstanding is 9.5 times more. You look at this and think, if you invested back here, and you might sit there and brag, look, the revenue's up 6 cents since I bought it. Yeah, but you also have 9.5 times more partners than you did before. That means you've seen a loss of wealth, even if you're valuing the company based on these original numbers growing that much. That is the importance of understanding the shares outstanding and how much they increase. The 8 pillars obviously suck because there's a lot of negative numbers here. Guys, let's see what the analysts are saying, because this is purely a play on the future. And remember, just because a company loses cash flow now doesn't mean it's not a good investment. Companies can grow and spend a lot of money growing, and that's really increasing the intrinsic value of the business. And they might spend a lot today to do that. But remember, every investment is the present value of all future cash flows. If you have a few years of losses, it can still make sense. I'm not saying that's the case with SoFi. What I'm saying is don't just get stuck on this like I used to do. Company's losing money now, it's not worth anything. Well, no, that's not true. It can be worth something. When I buy real estate, I rarely make money in the first 2 years because I'm putting so much money in the property. I'm losing cash flow because I'm putting so much money in the property. But then guess what happens in year 3? My cash flow skyrockets because all the renovations are done. We've increased rents. We've kicked out bad tenants. No difference here. If a company is investing in growth and that growth is highly profitable, but they spend more and more and more money growing, that's great. I want them to spend that money growing. You want them to spend that. Problem is when they're spending it by diluting you as an owner, that's what sucks. So they're expected to make 27 cents per share this year, growing to 85. That's 3x in the next 3 years. 85 cents a share though, even at today's prices, that's 17 to 18 times. At what point do they have to stop spending on this for growth? Let's look at revenue growth. 15%, 16%, 15, 14. A lot of growth. Is it worth it to see that dilution? When's the dilution going to stop? That's one of the things I want you to understand about SoFi. When is the dilution going to stop? So let's see here and go to our stock analyzer tool. Guys, this is why the stock analyzer tool is so important. We have the story. We have the story of SoFi. It's a great story. There are negatives about it. But at the end of the day, every investment is the present value of all future cash flow. And this allows you to merge the story with the numbers together. Your story is going to influence your revenue growth, your profit margin, all these metrics that determine the future cash flow of the business. And you bring it to today, and that's what you're going to look at in terms of, is it a reasonable price? So for a 10-year analysis, have I ever done SoFi? Let's see my history if I've ever done SoFi. A long time ago, I did a 20-year analysis. Let's change it to 10 years. Revenue growth. I'm going to do 8, 12, and 16%. Might be low, but we'll see. For profit margin and free cash flow, I'm going to do 10, 15, and 20%. Guys, a lot of this is a guess because they only started making money recently. Could it be much higher? Yeah, potentially. But I'm still giving them double in the middle for their profit margin. Now for PE and price to free cash flow, 16, 18, and 20. Guys, the reason I'm giving them a premium is this company can grow and can grow a lot. The ROIC is even 2.3% on a really crappy year. So I'm like, okay, it could probably generate high returns and it's very easy to use. SoFi was very easy to set up. That's what I love about SoFi. And my desired return. Now, I, in the past, put 15, 20, and 25%. What I'm doing here is I'm going to go 9% here. And the reason being is I just want to see what's the intrinsic value. What's it worth if I want to match that 9 or 10% the market makes? Remember, though, you need to put that margin of safety in. So we've taken all the story, we've taken the numbers, we've put them together in the stock analyzer tool. It's going to tell us what we think SoFi is worth today. Hit the analyze button. I've got a low price of 5, high price of 22, middle price of 11. Guys, for me, I just look at this going with the dilution, with all the things going on. For me personally, I'm a hold on it. What you do is different though. You might understand this business better than I do. More power to you. If they keep increasing their fees from 38% to 49% as a percentage of the revenue, that could really generate a lot more profit for the business. So there's a lot of potential here. But for me, I'd rather just sit back and wait until I can really understand the company because these negative numbers here on free cash flow just kind of irk me a little bit. That doesn't fit my kind of investing style where it's so inconsistent. But guess what? The same thing I said about Amazon and Tesla and Netflix. I didn't understand that. I'm okay with that. If you're not okay with that, if you understand it, more power to you. Stock number 2, super microcomputer. They are making waves in high performance server world. And this story is one of explosive growth and innovation. First, think about the staggering number. In the fiscal year ending June 2024, Supermicro reported nearly $15 billion in revenue, a jaw-dropping 110% jump from the previous year. What's fueling this rocket? AI, artificial intelligence. The booming demand for AI, optimized computer solutions are driving their sales through the roof. And Supermicro isn't just riding this wave alone. They've partnered with tech juggernauts like Nvidia, I'm sure you've heard of them, to deliver state-of-the-art servers packed with GPUs. The GPU is what's driving this AI boom for chips. Now, why are they winning in the AI server space? Well, Their secret sauce lies in innovation, especially their direct liquid cooling technology. AI workloads are notoriously power hungry, but Supermicro's cooling solutions slash the energy costs while boosting performance. This is especially important. Guys, you see your computers, you hear that fan running. It's trying to keep the computer cool. The same thing happens on these servers. But there's more. Supermicro's expansion isn't just about tech, it is global. They're ramping up production worldwide, including a shiny new campus in Malaysia, positioning themselves to meet surging demand internationally. So, what's the bottom line? Supermicro is leading the charge in AI server solutions with innovation, strategic partnerships, and global ambition. For value investors, their rapid growth and dominance in a booming sector make them a compelling story. Just remember that, guys. For value investors, everyone thinks that value investors don't value growth. Incorrect. You see in our stock analyzer tool, the very first line is revenue growth. The point is, every investment's the present value of all future cash flow. And if you think that you cannot find a value on a growth story, guys, you gotta readjust that thinking. There's value in everything. It's about figuring it out. So, look at this company, guys. This is incredible. All-time high, March 8th of 2024 of $123, 52-week low just 2 months ago of $17.25, and it's currently at $31.50. Is that volatility or what? Incredible, guys. $19.5 billion market cap, negative free cash flow last year, 5-year average. In fact, look at this. Their 5-year average free cash flow is better than their 1-year average negative free cash flow. And look at the net income numbers, just very different. So you got to understand what's the difference here. Is it a lot of capital improvements? Because capital expenditures take out of free cash flow. So is it making up for that in the net income area? Over long periods of time, those are going to equate out. One thing I do like about this company, I like this price to sales ratio. What I don't like is this gross profit. 16% gross profit. Guys, this is a car company gross profit number. That's what's incredible to me. 3-year compounded revenue growth, 51%, 26% over the last 5 years, 24% over the last 10 years. And yet this gross margin of 16%. It's a little rough to me, a little rough. Selling for 18.5 times earnings. So guys, again, these are exciting businesses. This is why we're looking at these, because we sit there and say, hey, these exciting companies, they're selling for $150 a share. So people out there can get a lot more shares for $500. But remember, what's behind the shares? Let's go check out the pillars, if there's anything even valuable in the 8 pillars. All right, a lot of X's, but revenue growth, net income growth, cash flows down. Guys, these are exciting businesses. Exciting businesses tend to have bad pillars because they're growing like crazy. This is why we tell you about the pillars, like don't focus on these to determine a value or whether you buy or not. These are about telling a story. And what's the story here? A lot of growth, and they're hoping that everything else catches up. Hoping everything else catches up. That's what's incredible. And obviously no free cash flow in the last 5 years. You got a really high 5-year PE. Let's go look at their actual income statement because I want to show you this growth here. Look at this revenue growth. $1.5 billion, $1.9 billion, 2.2, 2.5, 3.3, 3.5, 3.3, 3.5, 5.2, 7, 11.8. This is the AI boom right here. So the question you have to ask yourself is this a permanent plateau for the business? Or is it not? I mean, I look at Nvidia and their gross margin on Nvidia is like 75%. This one's 16%. But then again, Amazon has a very different gross margin that they report on their financials versus their annual statement. Very different numbers. Is this the same thing? So guys, let's see what analysts are saying about Supermicro. Well, $3.25 per share this year in profit, growing to $4.43 in 2 years, 33, 26, and 8%. But guys, look at this. The revenue growth, they think this might be what is this jump? 78% jump in revenue this year, 15% next year, 10, then 4. This is all over the board. I look at this thinking to myself, is this just a crapshoot? Maybe. Look at analysts. They're not even, I mean, analysts think there's going to be less revenue in 5 years than they are going to have today, that they're going to have this year. But they have $11 billion in revenue in the last 12 months, jumping to $27 billion. I don't know. This seems maybe a little hard to understand. So let's go to our stock analyzer tool. Let's see what this thing says. I don't think I've ever done SMCI. I probably have, and I just don't even realize it. I've never done it. So we're popping our cherry right here. 10-year analysis, guys. Okay. Revenue growth numbers for the next 10 years. This is tough. 5, 12, 19%. Profit margin. Let's go with 5, 8, and 11. Free cash flow. Let's say it all evens out. We're going to keep it the exact same as our profit margin. Now PE, 15, 20, and 25. And 9% desired return. Guys, remember, these are all guesses. Why? Because we don't have much. I mean, the profit margin is the only consistent history and it's getting better, but I still go back to that 15% gross margin. You can't make 20% bottom line if your gross margin is 15. The gross margin is on every extra unit you sell. How much profit are you making? So it can't be higher. The bottom line margin cannot be higher than the gross margin, unless there's a one-time gain or sale of an asset or something like that. So this is something that's, I'm going to assume in a lot of these situations that it just gets better. And that's a fair assumption. As companies grow, they can become more efficient. Now, guys, you're seeing me use this software, and it's making things a lot easier for me to understand. So if this has been of interest to you, you've probably been to our website, everythingmoney.com, to sign up, and you've noticed that we have a wait list there. And the reason being is today's software includes everything we have to offer about stocks, trading, retirement, real estate, everything there. But behind the scenes, we're making changes. That offer is going to go away soon. Now, guys, you watched some videos from last week. These changes are already occurring. This is not how it looked last week. So these changes are absolutely happening now. I've been saying it for a while, but they're happening now. So the offer that we're giving right now of everything except for trading is going away very soon. I built this software for myself and my team so I could use it to continually help me make suitable investments in stocks and real estate and make the right decisions for my future self. But as we've grown, it's become less about me and more about how I can better serve you and this community. And this is why we're updating the software. Our community chat is becoming even more popular, even more used. People are engaging like crazy, talking about their investment ideas with markets at all-time highs. Imagine when markets are low, how valuable these tools will be. Because everybody in the world is going to be out there scared, worried. What decisions do I make? But you're going to have the right tools to be able to make those decisions. So all these changes haven't been made yet. So join today. You'll be grandfathered in for life, and this is the best deal we've ever offered. There's still time for you to sign up. So as long as you join the Everything Money community now, before we make the changes, you will keep this plan and you will stay locked into your pricing tier forever. So click on the link in the description below to get access to everything we have to offer. And I guarantee you that this will be the best investing decision you made all year. It's $1 per day. Imagine the cost of $1 per day to have peace of mind when markets are falling by having like-minded people and all the tools to make these decisions. So what's the value? I hit the analyze button. Boom. Wowzer. Okay. 17 on the low side, 157 on the high side, 56 in the middle. I was not expecting this. That means at today's price, if my middle assumptions occur, you can expect about a 17% return on your money. I was definitely not expecting this, guys. But again, these assumptions above, they have to be validated. Are they the right assumptions? I can make assumptions all day, but garbage in, garbage out. I haven't verified these are the right numbers, but I guarantee you there's somebody in the community who's looked into this company because this is a very exciting business. And we have thousands of people in this community, and people have looked at 4,664 stocks on our stock analyzer in 2024 alone. In fact, all time, 8,208 different stocks have been analyzed in our stock analyzer tool. Guys, that's incredible. That means we're looking at micro caps, mega caps, everything across the board. Speaking of mega caps, let's look at this next company. Lyft. Now, it's not really a mega cap. It's only a $500 billion market cap, but it's a much bigger company. And when it comes to ride hailing, we all think about Uber. But Lyft is carving out its own lane in this highly competitive space. Sure, Uber commands a whopping 76% of the US market. But Lyft has the balance. That 24% is nothing to scoff at. It's a key player in urban areas, offering riders a reliable alternative. And let's face it, a little competition can be healthy in markets. Now let's talk strategy. Lyft's price lock feature is a clever move. Picture this. You're rushing to the airport during peak hour, and Lyft saves you from the dreaded surge pricing. That's what Price Lock does for subscribers. Consistent fares and less stress. Riders love it, and it's driving loyalty while increasing ride frequency. It's a classic example of how creating value for customers builds a stickier business. Now, with that said, me being the business cynic says, at what point do they just sit there and say, we're just going to start surge pricing once they get big enough? That could happen. But Lyft isn't stopping there. They've rolled out 33 new features in their app, and they're teaming up with Mobileye to launch autonomous rides in Atlanta by sometime this year. While the AV space is still maturing, Lyft's strategic partnerships give it a shot at staying relevant in this future-forward arena. Financially, Lyft has a narrow focus: North American ride-hailing only, which keeps operations streamlined and costs in check. Analysts even see potential for profitability soon. For value investors, this signals an interesting opportunity if the price is right. So what's the bottom line? Lyft might be the underdog, but its adaptability, customer-focused strategies, and AV positioning make it worth a deeper dive. In investing, it's not about being the biggest. It's about finding value where others overlook it. And it's very easy to overlook the second person. Lyft's story has plenty of room to unfold. And for patient investors, it could be a worthwhile ride. So, like I said, $5.4 billion in market cap, $640 million in free cash flow, revenue of 5.46, gross margin 41%. So, they're selling for one-time sales at 41% gross margin. Very nice. So, let's see what the dilution is. 31% shares outstanding have been increased. Okay, that's a lot. Let's see how it's been the last few years. So we go to the income statement, scroll all the way to the bottom. Has it slowed down? Not really. 412 million versus 385 at the end of 2023, 354, 334, 312. So they're funding their losses by increasing their shares largely. That's great. More power to them, but you got to factor that in as an investor. Let's see what the analysts are saying. $1 in profit this year, going to $1.94 in 3 years, and revenue of $6.8 billion this year, going to 9.9. Steady growth, but not super high growth. Now, keep in mind, Uber is already profitable. Their current CEO did a great job a few years ago when the market shifted. He said, listen, the markets want cash flow now. That's what we're going to focus on. I like that a lot. A CEO who understands, listen, if we can't raise money for losses, we got to focus on cash flow. So let's go see what I did on the stock analyzer tool, if I've ever done it in the past. LYFT. Drum roll. Oh my God, another company I've never done. So let's sit here and do revenue growth. Let's go with 5, 10, and 15% revenue growth. Profit margin. Well, let's see. At 40% gross margin, let's say they can do 8, 12, and 16, 8, 13, and 18% free profit margin. And I'll do the same thing for free cash flow. Now look at this. Their free cash flow last year was 12%. So maybe it can get better than this 13% number. Maybe I'm being conservative. Let's do this. Let's do 8, 16, and 24 then. Now again, I'm not using this right now as my determination if I'm going to buy it or not. On the last company, I was looking at it going super microcomputer. I was looking at it saying, okay, well, this is a lot better than I thought. Maybe I should look into it deeper. That's what's great about the stock analyzer tool. Use it at the beginning to decide, hey, am I going to look further? And at the end to say, okay, I'm refining all my numbers. What's the right price to pay? That's what's great about it. PE. I'm going to go with 13, 16, and 19. I went a little bit lower only because of Uber's dominance and my 9% desired return. Again, especially with its being second player, I think you need a higher desired return, a higher margin of safety. Hit the analyze button. Boom. Okay, guys, we got another one. 17 on the low side, 141 on the high side, $57 in the middle. A lot of potential here. You need to get in the community and start talking about this. And guys, if you want to watch stocks at the 2-week low, it's a great place to find value. Watch our next video. I'll see you in the community. Thank you for your time.